Welcome to the Tricord Advisors podcast, where we answer life's hard questions to help you make smart decisions with your money. I'm Jeremiah Lee, and this is Randy Barkley. We're both certified financial planners. I'm also a California licensed attorney.
So they've done it again. Congress just can't leave things alone, right? What they're doing is they go in and so now they're making the comments, they're making the request that every 401k offer a Roth provision. So they're putting that in, but then they went back and changed. No, they can delay it tonight to 2026. Okay. But a lot of firms now are putting this Roth in, so we're getting a lot of conversation with clients about, well, do I do a Roth? Do I not do a Roth? And the math it's not clear for everybody, is it?
No. So let's set the stage. This is great. They're at it again. I like that as a start. So what we're talking about today is retirement savings. When you save for retirement, there's a number of ways you can do it through a 401k or other types of plans. And when you, for a lot of people, we have a number of clients that they have been busy. They have put kids through college. They have bought houses. They've had careers. They get to about the age 50 or so, and they realize, hey, I'm behind. I have not put as much as I should have into retirement.
And in their highest earning years.
And they're in their highest earnings, yeah. So it's kind of, for some people, it's all going to plan. You know, right. They've got their kids through college. They're now in their highest earning management roles or leadership roles, and they have all more income than they need, finally. They finally made it. And now they look to their own retirement and say, oh gosh, I'm a little bit behind. And part of what is allowed through the tax codes is what's called catch-up contributions. To say I'm going to max out my retirement plans, but because I'm 50 and older, I can actually put extra in.
And for most people, their primary savings vehicle is their 401k through work.
Yeah.
So there's age related, and then there's catch-up provisions. So if you're under age 50, you have a certain dollar amount that you can, and let me put this one proviso in here too, make sure people understand this. The only way that you can get money into a Roth is by payroll deduction.
For a Roth 401k,
yeah. You can't wait until the end of the year and say, oh, by the way, I want to write a check and I want to put this extra money into my Roth. You can't do that in a Roth 401k. Yeah. It has to come from payroll deduction. I can't tell you the number of clients that I've talked to over the years, and they say, well, can't I just write a check? I said, no, the only way it gets into that 401k is that you got to talk to personnel. You got to talk to somebody that's handling your paycheck. That money comes out and that goes. And now we could talk about how it's managed. That's a whole nother conversation. But it's really important for people to know the only way you're going to get money in there is that you have to get a payroll deduction to make that contribution.
Yeah, that's great. And someone who's in their 40s
right,
is probably looking to get in as much as they can, but they still have to pay for life and kids and all those things. So they might be putting in 10, 15, maybe 20% of their earnings are going in out of their paycheck, going into their 401k plans. Well, now, just as the example, you're saying 2023, someone can put $22,500. That's what they can put into their retirement. And for someone in their 40s, that sounds like a massive amount of money.
Right.
Someone who's 50 plus and their kids are out of the house and they're making the highest income.
Mortgage payment is down, or maybe no mortgage payment anymore. Yeah. Those obligations are gone.
They say to put $22,000, and I could do that. In fact, I want to put more in because my retirement is coming up.
Right.
And so the catch-up provision is that you can put an extra $7,500. So it brings the total to $30,000.
Now we're just talking about 401ks. Now we're gonna cross over to Roth aspects of it. Okay. But generally speaking, if you put money inside of a qualified plan, a 401k is a qualified plan. Just so everybody's aware, the 401k refers to the tax code. So if you're a tax nerd, you can actually go to the tax code and look it up, and it spells out exactly what a 401k is, because there's different kinds of 401s. But you get a tax deduction. So what it does is it reduces your income by whatever dollar amount that you put into it, unless you choose to do a Roth, right? Yeah.
So for a traditional structure, say someone's making $100,000 and they put the $22,500 into their retirement, that's going to bring down their taxable income.
So if you're
a little bit over 70,000.
So if I'm in a tax bracket, and generally speaking, for somebody in their 50s, typically if they're making reasonably good money, they're going to be in a tax bracket of 28% for the federal, and they're going to be upwards of 7-8% for state. We always tell people, generally speaking, about a 34% tax bracket, for what you're putting in. That's what you're saving on taxes.
Yep. So if you need the income, of course, you have to pay the taxes and receive the
Right.
income. In these moments where you can put it into retirement and save for your future, you can avoid those taxes. So as someone reaches the age 50, they say, I could do the 22.5. I could put that in and it will save me some taxes. Won't this be great? And then age 50 plus, they can do the catch-ups and they can put that in there. And that's kind of how it's worked for a number of years. Right. And they would use that extra 7,500 as their catch-up contribution, bring it to 30,000 total. And they'd avoid those taxes. Their tax bill comes down.
But wait a minute. If I'm not paying any taxes on that, when am I going to pay taxes on this?
Yep, that's good comment. So when they retire, when they enter in the retirement and their income comes way down because they've stopped working, and they start taking out of these retirement accounts, they start pulling out, $30,000, $40,000, $50,000 to live off their accounts. That is counted as income. So they didn't actually avoid or skip the taxes. They've just delayed the taxes.
So my required minimum distribution comes out, and now this is where Congress, don't you love them? So if you're born before 60, you now can take it out of 73? But if you're born after 1960, you can wait till 75, right?
Yep.
For your required minimum distributions. So, people are going, what am I supposed to do? Maybe you've already started, or there's rules for those of you that have already started your required minimum distributions. We're not going to talk about that necessarily today. We're trying to just talk about, should you or should you not do a Roth account at this stage in your life if you're getting close to retirement?
Yeah, and that used to be the analysis, and we'll talk about that a little bit today. The rule that the IRS is putting their fingers into is they've changed that choice, really. The rule that's going to go into effect is saying if you're over 50 and you want to do this catch-up, that extra amount of money has to go into a Roth. That's the new rule that's going to roll into effect. Is they've no longer given you an option to decide, do I want to pay my taxes now or pay my taxes later? They've kind of by default told everyone, if you want to do a catch-up, you're going to have to pay your taxes now. And we can zoom out a little bit and think of the reason the government passed 401ks years ago and kind of created this new structure was that companies used to offer pensions and they were offering fewer and fewer pensions. And so the government said, how do we get people to save? Well, let's give them a tax break. So they kind of did some social engineering through the tax code and got people to delay paying the taxes, save these accounts. Well, now I'm not sure exactly what the social engineering here is. Is it that the U.S. government is saying, we want your money, we want your taxes?
Yeah, I mean, the commentary is there's several commentaries that I've read is that this is a way for the government to increase taxable collections now, because remember Roth, you get no tax deduction.
Yeah, that's a good one to remind people of. When you do a Roth account, it's still a 401k. It's just called a Roth 401k. It kind of flips things backwards. Whereas the traditional account, you don't pay taxes now, but you do pay them when you take the money out. For a Roth account, you pay the taxes now, but you don't pay any taxes in the future when you use the money. And it's nice when people enter into retirement that they have a Roth account. It's a wonderful thing that you can take the money out in the future without having to pay additional taxes.
Yeah, and again, the question is, we're not talking about conversion of a retirement account to a Roth. We're talking about your contribution to a Roth now. And again, I always go back and look at the calculation of what is the tax savings and put that as a contribution that the government is helping you to save money. So what are the deciding factors of why I should do a Roth or do a traditional tax deductible program into a 401k? Right. Let's say I'm 55 years of age. I plan to retire in 10 years and I want to accumulate more money. What are the things that I need to look at to make a decision whether I should do a traditional or a Roth 401k contribution?
It kind of comes down, there's a lot of factors we'll talk about. It comes down to a personal lifestyle of kind of where you're at and what you're doing. So the first one I would think about is, how long do you have until retirement? If you are going to retire in 3 years, the benefit of getting this tax-free savings may not be that great, because you don't have a lot of time to let that money grow. On the opposite side, kind of cut in the other direction, is what will your income be? If you're in your highest earning years now, any little bit of additional income gets taxed at those really high tax rates. Whereas if in a few years or many years in the future after you retire, if your income is going to fall all the way just down to, say, Social Security only, well, then adding a little bit of income there is fine, taxable income. So to shift it from your highest earning years into your lowest earning years, to shift that income tax can be really helpful for people. So the first I'd say is, how long do you have to let this go? And what do you think your income will be in each world, either now or in the future?
So we got to be the wizard, right? We've got to figure out how much taxable income somebody's going to have when in fact they're going to retire.
Yeah, and that taxable income, the other piece of that is, what are the taxes going to be?
Exactly. Yeah. That's the other side of the wizardry. That's the other side of the magic wand.
Yeah. So you might be looking out 10 years from now and saying, okay, I'm going to use this money in 10 years. When I take it out, my income will be low. So it looks like a good reason for this. What do we think tax rates are going to be? And that becomes a difficult question. I think government generally likes to increase taxes, but we've had taxes come up and down over the last 50 or 80 years. So that's another piece, is what do you think tax rates will be in the future?
Yeah, I think that, again, where I kind of look at is, I don't trust the government. Bottom line is, I don't mean that to be revolutionary, but I'm just saying, I think that they put laws in place and they change the rules because they want to increase the revenue. And I'm very concerned that people are going to be set up for additional expense down the road. And I think that's where planning really gets into it, because again, the Roth can provide tax-free income, but it used to be that it was also kind of a collection where you could leave this money in place and your heirs could literally pull out this money over a long period of time. Well, now after these changes that they've made recently, they have to take it out over 10 years, albeit it's tax-free, but they can't let it just sit in there tax deferred. They still have to take it out over a 10-year period. So again, the government makes changes. I mean, Congress comes down with new rules and new regulations, and who knows what their changes are going to be, 5 years from now, 10 years from now, much less 20 years from now, right?
Yeah. And it's kind of the impetus on each person to build their own retirement, I guess. Right. Like I said, years ago, they would work for a company for 30 or 40 years. They get a pension and they were kind of taken care of. Well, with the demise of pensions and as a regular item of our working world, now it's kind of each individual to kind of build their own retirement. That starts with perhaps a 401k, but it can include a Roth 401k. It can include annuities. It can include Social Security, and having to kind of cobble together your own plan of the future, which candidly, when I sit down with a client, it's very seldom that they have one asset or one income stream. It's almost always that retirement is a mezzanine of income, that they have some Social Security, they might have some pension income items, they might have a few different accounts, and having a Roth or a 401k are all very helpful. And so I think for each person, as they look at saving for retirement, it's not just about put more money in. And that may be the simple thoughts when you're 20 or 30, just get the money in there. But really, even at 20 and 30, but at any time, thinking, okay, not just getting it in there, quote unquote, whatever that means, but getting it into a specific type of plan that's going to benefit your future. And there's multiple types and multiple structures, whether it's a Roth 401k or regular 401k, or even these HSA plans, these health savings accounts. There's multiple items to really set yourself up for success. And it takes some understanding and takes some doing to kind of say what's going to be the best for me in the future.
Yeah. So let's take a break right now. I want to come back and I want to talk about what age and what would be the best benefit at, let's say, age 20 versus somebody at age 55 using a Roth account versus not using a Roth account. So stay tuned and we'll be back and we'll continue our conversation on Roth accounts.
Welcome back. We are talking about Roth 401ks and kind of the new laws that Congress has passed recently. And just as a little bit of a recap, so if high earner, so someone who makes $145,000,
that's the limit that the IRS has set as kind of a benchmark for Roth contributions. If you're making at least $145,000 or above, there's some limitations, right?
Yeah. So if you make $145,000 or more and you want to do what's called catch-up contributions, these are after the age 50, you can still do them. You just have to put them into a Roth account. And so that's what we've been talking about a bit and kind of how we've got here. But the question I think that a lot of people would want to know is who is this going to help? Who is this going to hurt? And the biggest one that I see, I'll start with the hurting type of a world, is if somebody is a couple of years from retirement and they're making the most money they've ever made, and some of their deductions maybe have come down because they've paid off their house, perhaps their kids are out of college, they are making a good amount of money. We'll just say they're making $200,000, and they want to save more for retirement. They've maxed out the regular 401k, and they say, oh, I can do catch-ups. I'm over 50 years old. I want to do a catch-up contribution to get even more into my retirement account because I finally have the free cash flow. That they want to do that in the hope being that they would bring down their taxable income while they're working and then be able to take out that money in a few years later once they
And
retire.
again, the income that you take out when you reach, again, your required minimum distribution age, again, it could be several years after you retire before you're required to take anything out, right?
And the hope being for this individual that their income has really come down. Maybe they just have Social Security as their only income after they've retired. So for that family, that household, they would really like to take that catch-up contribution and put it into a traditional 401k. Avoid the taxes now, get the money into the plan.
Right.
They'll take the money out in a number of years in the future, 3, 4, 5, 10 years in the future. They'll take the money out and they'll pay the taxes then, but they're expecting that their tax rate will be much lower because they've stopped working. And so what this law is basically, it's kind of tying the hands of that individual, saying, well, if you're at this higher earning level and you're a little bit older, if you want to do these extra catch-ups, we don't want to let you skip these taxes anymore. So we're going to make you put that extra catch-up into a Roth account, which means you pay the taxes now. So for those people who are a little bit later in saving for retirement, they're at high income levels and they're going to retire in a number of years. For them, I'd say this law is kind of detrimental, that it is forcing them to pay their taxes now, even when their incomes are very high. They can still get the money into the plan and they can still have a Roth, which there's some benefits there, but they're not going to be able to skip out on the taxes.
So let me pull a lever for you. I deal a lot with retired people, and those clients that are charitable, let's say that they give a fair amount of their income to charities, whether it be church, education, medical, whatever it is. Now, if you're 70 years of age, you can actually take your charitable contributions directly out of your IRA or out of your IRA. Now, this is where it gets a little tricky. You don't have to take out required minimum distributions until you're either 73 or 75. But if you are charitable, you can contribute. You can take out your charitable gift out of your IRA and probably do it when you're reaching that required minimum distribution age. So that would help reduce your taxable income. It also could have an impact on Medicare premiums for you also. So again, there's a lot of levers here that are being pulled and pushed all at the same time in a relatively short period of time. So from retirement age until either age 73 or 75, there's all these other factors that come into play to determine whether or not a Roth makes sense for you.
And even that conversation, if someone's charitably minded and they expect to be giving into their later years, that throws a little bit of a wrench in the analysis.
It does.
It's not just a math problem. It's actually a lifestyle conversation of what you'd like to be about, what you're going to be using your money for. Because to your comment, even if you got all this money into a traditional 401k type plan,
right,
and you've avoided all the taxes, in the future, when you're retired, you're going to start paying those taxes. However, if you're charitably minded, you might still skip those taxes by giving the money away into the future. And there's some real benefit for someone like that. I think the other view of this, and this is less applicable to this specific IRS change for Roth 401ks only, but as someone who's younger, I've had a number of clients recently that are in their 30s. They have their kind of first, I guess I would call it their career job. They're making the more money they've ever made. They don't quite have kids that are overly expensive at the moment. Their house is still a first kind of starter home, and they say, what should I do? We've had some great conversations about a Roth 401k, putting it into a Roth. So go ahead and you pay your taxes. Like, you're only in the 22% tax bracket,
right?
Which for them at the moment, it still feels like, well, I used to be 15. Now I'm moving up, and it feels like a larger tax bracket. However, it is kind of the reason they're talking with us, trying to get this longer term wisdom of saying, how can I help build my life forward to say, okay, for the next 3 or 4 or 5 years, you're in a relatively low tax bracket and you can build up your Roth.
So what do you recommend to them if they've got an option of doing a 401k traditional and a 401k Roth? What if you got somebody who's 30 years of age, what is it that you think it would be best for them?
Yeah.
Is there a standard rule?
There isn't. There's no standard rule, and it has a little bit of what they're expecting into their future. This is just the start of a career that's going to be very profitable and make really high income. Others will have the conversation about future tax rates, and they look at the current administration. They look at what's probably going to happen politically over the next 20 years.
And who can predict that one?
They can't, right? But they'll say, do you think taxes will be higher or lower 20 years from now? And I've had a number of them that say, well, I can't imagine them not being higher. And so,
yeah, and I have to say that when the Roth first came out, that was basically the key argument, is that you're going to have higher tax bracket it was a generalized statement that you're going to end up paying more taxes in retirement than you are working. I don't think that can be just a truism. I don't think that's just a natural given anymore.
Yeah. Yeah. It needs to be a real, and part of that, clients can look to us and we can talk through that. But a lot of that is not something we know either. It's simply someone looking at the world and saying, this is the assumption, or this is what I anticipate. So I want to plan accordingly. But for many people, getting money into a Roth, in that example, someone who's in their young 30s, is a great option. And often when I speak with people, it's not a either or, make one choice and go all in. It's often a both and. That we'll talk about, okay, how much money would be appropriate to go into a traditional, save some taxes.
So you're kind of hedging your bet.
And doing both, yeah.
Yeah.
And allowing them to contribute to both a 401k that's a Roth and both a 401k that's traditional. Now, there's a cap on how much you can put into 401ks in general. So you have to kind of divide how much you'd like to. But I think both is a great option. And there's certain years where they might not need the tax breaks. There might be another reason they have a loss, or they have a lot of interest.
Yeah, I mean,
in those years, they can lean more heavily into the Roth contributions. So I think it's not a one-time choice, but it is something that is a opportunity for people to really do some strategic planning that doesn't just impact what they're doing now, but it's really looking forward of the life and what they expect to be doing in the future. And we expect that to change. So there has to be flexibility.
Yeah, and the thing that I keep when I'm listening to you, and I mean, I'm thinking through clients that I've had, and early stages, maybe the spouse didn't work outside the home. Later stages, both are working and the income goes up. There's so many dynamic parts to somebody's life financially, to be able to just kind of lock in at one point in time, let's say at age 30, and say, this is what we're going to do forever. It doesn't fit in my head, because your life it's not just a steady stream here. I mean, it's going to change as time goes through, and your circumstances are going to change, right?
Yeah, the more people can do good planning and make good choices early on, the more opportunities they'll have as they go forward to be flexible.
So what you're hearing is that no one thing is going to solve the issue or answer the question regarding Roth. This is why you need to develop a plan. And this is why we suggest that you develop a professional relationship with us, because we can help you through those things that can have a lot of questions down the road.
If you missed any part of this episode, you can find us on our website, tricoreadvisors.com, or you can find us on YouTube.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.